Hello and welcome back to another stock analysis on Stock Market Palantir. Make sure to subscribe and let us know your thoughts in the comments. Now, let's hear from our analysts.
Okay, we have to start this discussion by just immediately acknowledging the dramatic, almost vertical price action we've seen in Grab holdings. The stock just absolutely roared from the low $4 range right up to a 52-week high of $5.72 in mid-December.
Yeah, and that move is significant, but what really makes it the core of our analysis today is that it happened alongside, exceptionally high off-exchange trading activity. We saw that off-exchange short volume ratio spike, right? It reported 54.50% on December 12th.
Exactly. And that volume metric, that is the hinge upon which this entire discussion turns, doesn't it? It establishes the central tension here. Is this sudden, intense market momentum a rational reflection of Grab's underlying turnaround, or is the velocity of the rally fundamentally driven by, technical factors, market structure, dark pools, and just high-stakes speculation?
And that's where I land. I contend that the price action we observed above 550 is overwhelmingly defined by those volatile technicals, the influence of that opaque market structure, and the binary regulatory risk looming over the company.
I see why you anchor the discussion there. I really do. The dramatic price chart, the high off-exchange volume, it all invites skepticism. But let me give you a different perspective. I believe the stock's recovery to the, say, 550 to 572 range is absolutely a rational market response to a genuine operational inflection point. The market is finally rewarding certainty.
Certainty? What certainty are we talking about?
We're looking at the Q3 2025 results. $873 million in revenue. That's a 17% year-over-year increase. And crucially, on-demand gross merchandise value, that accelerated to 21%. So the whole narrative that Grab is a perpetual cash-burning startup is, well, it's finished. They have established a clear, credible path to GAAP profitability. That's generally accepted accounting principles, which means they are moving beyond adjusted numbers and into true reported net income. And that operational improvement is backstopped by the balance sheet. They hold a $5 billion cash buffer that removes any, existential or insolvency risk for the foreseeable future. That is the necessary precondition for any rally to sustain itself.
Okay, but are we really looking at a 17% revenue growth company being suddenly re-rated by 40% based purely on its operational efficiency? I don't buy that. That level of operational improvement justifies a slow, steady climb, maybe establishing a new support zone. The spike? That aggressive, near-vertical move is primarily driven by the speculative merger premium associated with the renewed rumors of consolidation with their rival GoTo. And while that merger is strategically brilliant, it's the ultimate binary, high-risk event. If it is blocked by the Indonesian Competition Commission, the KPPU, that entire speculative premium will evaporate overnight. We're talking about a deal that could result in the combined entity controlling over 91% of the Indonesian ride-hailing market. That's a massive regulatory red flag. It introduces political risk, not just market risk.
And that leads us directly back to the volume question, doesn't it? You pointed out that when retail investors see a ratio like 54.50% off exchange, the immediate response is a discussion of naked shorting or manipulation, a belief that the price is being suppressed in the dark. How much of the volatility do you attribute to that structural ambiguity?
I think the ambiguity is key, and the perception it generates is inseparable from the reality. The high variance in that volume, 74.72% on December 11th, regardless of the mechanism, it creates an environment of volatility and fuels retail distrust. For the average investor, looking at the public order book, this structure inhibits transparent price discovery. The conspiracy narrative, while often misinformed, it exists precisely because the structure is so opaque. It creates this persistent headwind.
Here and understand the true mechanics. The high off-exchange volume is actually a structural feature, and it's driven by two primary non-nefarious forces. The first is institutional block trading. Think of the public exchange as a highly visible auction. When massive institutions like BlackRock or Temasek need to trade millions of shares, they do not want to put a giant sell order on the public exchange because that just signals their intention and moves the price against them.
So you're arguing that the world's largest investors are essentially doing a private, negotiated transaction away from the public eye because they don't want to alert the market.
Exactly. It's about efficiency and discretion for massive size. And the second driver is wholesale internalization. Grab is heavily traded by retail investors on commission-free platforms. Those brokers route the orders to wholesale market makers who fulfill the trades instantly. And those transactions are reported as off-exchange trades. So when retail activity spikes, as it did during this rally, the dark pool volume naturally spikes too.
I'll concede that internalization and block trading are the mechanical reality, and that the short interest, sitting below 8%, is, well, too moderate to suggest some massive conspiracy. However, I still maintain that the structural reality is problematic for genuine price discovery. If institutional accumulation is masked off exchange, while genuine short sellers, the informed traders who think 572 is wildly unjustified, prefer lit exchanges because they want to maximize downward price impact, then the structure inherently favors the sophisticated sellers over the public buyer. The true informed bearish sentiment is more visible than the informed bullish accumulation.
That may be true, but that structure is the norm now, not the exception. Let's transition back to the core argument, the fundamentals acting as a safety net. If the rally were purely speculative, it would have crashed, but the fundamental improvement provides a necessary valuation floor. We've established solid support around that $5 zone. Management raised its full year 2025 revenue guidance, confirming the trajectory. And more critically, the fintech arm, which used to be a drag, grew 34% and is projected to hit break even in 2026. This operational strength means the stock has a safety net. The institutional accumulation validates the turnaround, not just the rumor.
I understand the argument for a floor, but let's force the issue. If the KPPU blocks the Goto merger tomorrow, where do you sincerely believe the floor for Grab stock is the day after? Is $5 achievable, or does the market panic and re-rate it down to $4, acknowledging that the exponential growth potential has been severed?
Well, the $5 level is supported by the operational metrics and the cash on hand. We have to remember that even without the merger, Grab is still the market leader across Southeast Asia and is executing on a successful path to GAAP profitability. The merger premium accounts for the velocity of the move, not the baseline value.
That's a compelling argument, but I'd counter that the difference between the analyst consensus, which is high, between $7 and $8, and the recent 572 high is almost entirely attributable to that go-to premium. You strip out that optionality, the stock is merely performing according to its fundamentals, which would place it right around that $5 floor. The explosive momentum above 550 is purely speculative, and we have to consider the political layer. The involvement of Indonesia's sovereign wealth fund Danantara suggests this isn't just a corporate transaction, it's a matter of national economic control. That adds a non-fundamental risk you simply cannot model.
See, I frame the Goto merger not purely as speculation, but as strategic future-proofing, and the market is correctly assigning a higher multiple for that potential. This isn't just about market share, it's about changing the risk profile entirely. It moves Grab from a competitive gig economy player to a dominant market utility with pricing power. That is a fundamental re-rating of the business model and justifies the enthusiasm.
That institutional positioning is looking forward, yes, but we can't ignore the significant headwinds from the stock's baggage. The retail community is fractured and defined by what I call bag holder fatigue from the SPAC era, where many got in between $10 and $16. This lasting cynicism and distrust of management, often citing the dual-class share structure, acts as a persistent emotional headwind. Every rally, like this one, is seen by that cohort as an exit opportunity. That profit-taking caps the upside.
That fatigue is a real psychological factor, but the market is driven by forward-looking cash flows, not backward-looking pain. Institutional accumulation, funds like Legal & General Group increasing their positions, shows that smart money has moved past the SPAC history. The true forward-looking indicators are the institutional buy ratings and the technical breakout at that $550 pivot point.
But you have to admit the persistent misinformation that haunts this stock. I mean, the lasting confusion over a reverse split that factually never occurred, for example, it highlights how complicated that de-SPAC transaction was, and that lack of clarity feeds the very distrust we're talking about.
Oh, absolutely. It's clear that the complexities of that transaction continue to fuel misunderstanding. It's an information asymmetry problem that compounds the risk. So if we step back, where do we ultimately land on the primary driver for this rally to 572? For me, the core investment thesis remains anchored in the company's clear, verifiable path to GAAP profitability, the strong Q3 results, and that foundational $5 billion cash cushion. The rally is fundamentally justified by the operational turnaround. The underlying value is real, even if the speed was accelerated by merger whispers.
And I'd say I agree that the fundamentals provide that necessary foundation, that floor near $5. However, I maintain that the extreme movement and the stock's future volatility are dictated by technical structure. That high off-exchange volume will continue to create skepticism and, most importantly, the binary political outcome of the GoTo merger. This stock is, fundamentally, a battleground where operational efficiency is secondary to regulatory approval.
It is a battleground, but one based on real, improving operational assets.
Real assets, yes, but subject to the political will of regulators in Jakarta. And that brings us to the ultimate conclusion for our listeners.
Indeed. The ultimate direction of this stock, whether it moves towards that $7 analyst target or sees its premium violently evaporate, it hinges entirely on the political decision coming out of Jakarta regarding the Indonesian Competition Commission's stance on the GoTo deal.
It is the high-magnitude regulatory risk, not the next earnings report, that determines the stock's next $2 move.
If you enjoyed this video, subscribe to the Stock Market Palantir channel for more stock reviews like this. Thanks for watching, and see you next video.